Nobody was ready for it. Not the analysts calling for 6,000 gold, not the traders who believed every dip was a gift, not the leveraged accounts stacked to the ceiling with futures contracts, because when it finally broke, it didn't drift lower, it collapsed. On February 12th, in less than 30 minutes, gold erased $700. Silver followed with a 10% single-session drop. Billions in paper profits disappeared almost instantly. Stops triggered, margin calls fired, screens froze while liquidity thinned, and the same market that felt invincible just days earlier suddenly felt fragile. Today is Friday, February 20th. The dust has not fully settled, the volatility hasn't vanished, and the real question is no longer what happened. It's whether this was a healthy purge of excess or the beginning of a much larger unwind. To answer that, we have to strip away emotion and examine structure. Gold's rally into late January was historic in scale and speed. The move from the mid-4,000 range into a record $5,627 per ounce created enormous wealth on paper, but it also attracted something else: leverage, speculation, late-cycle momentum chasers, the belief that this cycle was different. Parabolic advances feel unstoppable until they stop. The first warning sign came quietly on January 30th. Kevin Worsh was nominated as the next Federal Reserve Chair. That nomination was not just symbolic. Worsh is widely viewed as more hawkish than the existing leadership. Immediately, expectations shifted toward a higher for longer rate environment. Gold pays no yield. When interest rates are elevated and expected to remain elevated, the opportunity cost of holding gold increases. Capital begins to compare zero-yield assets to bonds and cash instruments that suddenly look attractive again. The market did not panic instantly, but the tone changed. The dollar began strengthening. Early investors who had ridden the rally started locking in gains. Momentum that once felt automatic began slowing. Then February 12th arrived. In a 30-minute span that traders will study for years, gold sliced through the psychological $5,000 level and continued falling. It briefly touched $4,900. From the highs, that represents roughly a $700 drop. In precious metals terms, that is not a routine correction. That is forced liquidation. Silver's reaction was even more dramatic. Silver had become the speculative favorite in late 2025. It approached $120 per ounce, fueled by industrial demand stories, supply squeeze narratives, and aggressive retail positioning. On February 13th, silver dropped 10% and settled near $76. When investors see moves like this, they assume fundamentals must have deteriorated overnight. They question whether the bull market is finished. They assume they misread everything, but price alone does not explain the event. The key to understanding this crash is leverage. When traders purchase futures contracts, they do not pay the entire value of the contract up front. They post margin, which acts as collateral. That margin allows them to control larger positions with less capital. During rallies, leverage magnifies gains. During declines, it magnifies losses. In early February, the CME Group implemented changes to silver margin requirements. Specifically, they shifted to a floating 18% notional value requirement. That means required collateral adjusted dynamically with price movements. When prices began falling, required margin levels effectively rose relative to account equity. Traders who were comfortably positioned one day suddenly faced margin calls the next. This creates a chain reaction. A trader receives a margin call and must deposit additional capital or reduce exposure. If capital is unavailable, positions are liquidated. When thousands of traders face this situation simultaneously, forced selling accelerates. The first wave of sellers is not selling because they lost conviction. They are selling because they have no choice. That selling pushes prices lower. Lower prices trigger additional margin calls. Additional margin calls create further liquidation. It becomes a feedback loop. This is why crashes can appear disconnected from news headlines. The market is not reacting to new supply data or mining output revisions. It is reacting to internal positioning stress. But leverage was only one component. Another crucial signal came from Shanghai. For months, gold on the Shanghai Gold Exchange traded at a premium relative to Western markets. At its peak, Shanghai Gold carried a $72 premium over COMEX pricing. That premium reflected strong physical demand from China, the largest physical gold buyer in the world. When Shanghai trades at a premium, it indicates buyers are willing to pay more to secure physical metal. It signals metal flowing from west to east. It creates a structural floor under global pricing. In early February, that premium did not simply shrink. It flipped. Shanghai Gold moved from a $72 premium to a $14 discount relative to Western prices. That is an $86 swing between the two dominant gold markets globally. When Shanghai trades at a discount, it implies physical demand has weakened. The floor that had supported elevated paper prices disappears. Without that physical bid from the east, Western leverage positions became vulnerable. The Shanghai Flip was a warning sign. Now consider the mining sector. Gold and silver fell sharply, but mining equities experienced amplified declines. Newmont, the largest gold producer, fell roughly 15% from January highs. Barrick Gold lost close to 13% of its market capitalization. Silver producers were hit harder. First Majestic Silver, known for its sensitivity to silver price movements, experienced aggressive selling. When the underlying metal declines 10%, high beta miners often decline significantly more due to operational leverage. Their assets did not vanish. Their cost structures did not fundamentally change overnight. What changed was capital flow and sentiment. Institutional funds reduced exposure. Technical traders hit stop losses. Momentum algorithms reversed. The final piece of the puzzle lies in technical momentum. During the final phase of gold's rally, the relative strength index climbed to extreme territory. RSI reached approximately 90. Traditionally, readings above 70 indicate overbought conditions. Above 80 signals extreme momentum. Above 90 often precedes reversals. More importantly, as gold made new highs in late January, RSI was trending lower, that is bearish divergence, price rising while momentum weakens. Each new high required less buying pressure. When you combine RSI divergence, a Shanghai premium flip, margin methodology changes, and a hawkish Federal Reserve shift, the probability of a significant correction increases dramatically. What we witnessed was not random chaos. It was structural fragility revealing itself. And now the essential question emerges. Was this simply the purge of excess leverage or the beginning of a deeper repricing cycle? That's where we go next. To move forward intelligently, we have to widen the lens. This crash did not occur in a vacuum. It unfolded within a broader macro environment that had already been shifting beneath the surface. One of the most powerful forces supporting gold over the past several years has been the de-dollarization trend. Central banks across emerging markets accumulated gold at historic levels. China, Russia, and several developing economies steadily increased reserves. The logic was clear: reduce reliance on the US dollar, diversify reserve assets, and hedge against geopolitical and monetary risk. That structural demand was genuine. Central bank buying provided a powerful narrative anchor. It gave investors confidence that gold had a durable floor. But when a narrative becomes universal, positioning becomes crowded. Crowded trades are fragile trades. In 2026, the US dollar index, the DXY, pushed back toward the 100 level. That strength was not just symbolic. It reflected tightening liquidity conditions globally. When dollar liquidity contracts, the demand for cash rises. And when participants need dollars, they sell what is liquid. Gold is liquid. Silver is liquid. This is where many investors get confused. They believe safe haven assets are immune during stress. But in liquidity-driven events, even safe havens can decline, not because their long-term value disappears, but because they are easily converted into cash. Liquidity needs override conviction. Now let's focus again on the levels that matter technically. For gold, 4,900 is the battleground. That is where the market attempted to stabilize after breaching 5,000. If this level holds and begins forming a base, it suggests the majority of forced deleveraging has already occurred. What we experienced was a purge of speculative excess. Traders who entered during the final euphoric phase with heavy leverage were forced out. That kind of cleansing can strengthen a market's long-term structure. Markets that rise vertically without interruption accumulate instability. Corrections, even violent ones, can restore balance. However, if gold breaks decisively below 4,900 with sustained volume and follow-through selling, then the analysis shifts. It would indicate that deleveraging is incomplete. It would suggest the market must search for a lower equilibrium before rebuilding. Silver presents a similar but more volatile picture. The $75 to $76 zone is where the market is attempting to stabilize. Silver's volatility profile is inherently higher than gold's. It accelerates faster in both directions. During rallies, it overshoots. During declines, it exaggerates. That volatility is not a flaw, it is a feature. Silver often acts as a sentiment amplifier. When silver underperforms sharply relative to gold, it signals speculative stress. When it outperforms dramatically, it signals aggressive risk appetite. This is why the gold-silver ratio deserves attention. A stable ratio implies coordinated macro-driven movement. A volatile ratio often signals internal stress and positioning imbalances. Beyond technicals and liquidity, we must revisit Federal Reserve expectations. Kevin Worsh's nomination altered the trajectory of rate expectations. Markets are forward-looking. They price anticipated policy shifts well before official decisions occur. If the leadership transition reinforces a higher for longer stance, non-yield assets like gold face continued pressure. If tone softens or economic data weakens materially, expectations could recalibrate again. The key is not predicting speeches. The key is monitoring expectation shifts. Now let's return to mining equities with this context in mind. Large producers such as Newmont and Barrick remain operationally profitable even at lower gold prices. Their all-in sustaining costs remain below current spot levels, but profitability alone does not shield equities during sector-wide rotations. When institutional capital reduces exposure to a theme, selling pressure spreads across the group, technical traders trigger stops, quantitative models adjust weightings. Liquidity thins quickly. Silver producers like First Majestic Silver experience magnified reactions because their earnings are highly sensitive to the underlying metal. A 10% drop in silver can translate into a disproportionate decline in expected earnings. That is operational leverage in action. But here is the critical distinction. The businesses themselves did not deteriorate overnight. The repricing was driven by sentiment and positioning, not sudden collapse in reserves or production capability. And this repricing may generate opportunity. Mid-tier miners that traded at premium multiples during the euphoric stage are now available at more attractive valuations. Larger producers with strong balance sheets could view this as an acquisition environment. Historically, consolidation often follows volatility spikes. However, not all miners are equal. Companies with disciplined management, manageable debt loads, and diversified asset bases are positioned to endure prolonged corrections. Junior explorers dependent on external financing face greater vulnerability if capital markets tighten further. Selectivity becomes essential. Now consider historical parallels once more. In 1980, Paul Volcker's aggressive inflation-fighting stance abruptly ended a parabolic precious metals rally. The shift in monetary regime expectations alone was enough to break momentum. In 2011, silver surged toward $50 before collapsing. The catalyst was rapid margin requirement increases by the CME. Leveraged traders were forced out en masse. In 2026, we witnessed echoes of both episodes. A hawkish leadership nomination, adjusted margin methodologies, extreme technical momentum readings, and narrative saturation. History does not repeat perfectly, but structural patterns often rhyme. Understanding those patterns does not guarantee foresight. It improves perspective. And perspective prevents emotional extremes. So is this the end of the bull market? The honest answer remains uncertainty. If structural drivers such as central bank diversification and long-term inflation hedging persist, this event may represent a reset. If liquidity conditions tighten further and dollar strength continues, additional downside risk remains. This is why reaction strategy matters more than directional certainty. If you remained positioned and avoided forced liquidation, patience becomes your advantage. Markets require time to establish new equilibrium after shock events. If you were stopped out or incurred losses, reflection becomes necessary. Was position sizing excessive? Was leverage too aggressive? Were warning signals ignored? Every major correction exposes weaknesses in approach. Going forward, three primary signals deserve disciplined attention. First, the Shanghai pricing relationship. Does the $14 discount persist or widen? Or does Shanghai return to premium territory? A return to premium pricing would indicate renewed physical demand support. Second, the gold-silver ratio. Stability implies coordinated movement. Volatility implies stress. Third, Federal Reserve communication and dollar behavior. Expectation shifts in policy directly influence liquidity conditions. In volatile phases, restraint often outperforms aggression. Markets are digesting a significant liquidation event. Sentiment has shifted sharply. Easy momentum-driven gains are behind us, but excess has also been removed. The speculative froth that propelled gold to 5,627 and silver toward 120 has largely been cleared. What remains is a market searching for structure. And structure, not hype, determines durability. Now we need to confront the deeper reality of what just happened. This was not simply a red week on the chart. It was a full stress test of the entire precious metals complex. It tested leverage, it tested conviction, it tested narrative strength, and it exposed where the market was strongest and where it was dangerously overextended. When gold was pushing toward $5,627, confidence was absolute. Analysts were racing to revise price targets higher. Silver approaching $120 felt inevitable. Social feeds were filled with projections of gold at $6,000 and silver at $200. The dollar decline was assumed permanent. Central bank accumulation was treated as an unstoppable force. But markets do not collapse because optimism exists. They collapse when optimism becomes crowded and leveraged. We had four structural stressors converging at once. A hawkish Federal Reserve nomination that shifted interest rate expectations, a floating 18% margin requirement adjustment in silver futures, an $86 reversal in the Shanghai gold premium from 72 above Western prices to 14 below, and technical momentum readings near 90 with clear bearish divergence. Each element alone may have caused volatility. Together, they created vulnerability. And when vulnerability meets leverage, moves accelerate. The first wave of selling was mechanical. Margin calls triggered forced liquidation. The second wave was psychological. Traders watching profits evaporate reacted emotionally. The third wave was institutional. Funds reduced exposure as volatility spiked. That layering effect is what transforms a correction into a flash crash. Now let's extract the practical lessons clearly. The first lesson is about leverage discipline. The traders who were destroyed were not necessarily wrong about gold's long-term potential. Many still believe the structural bull case remains intact. What eliminated them was position size relative to volatility. Leverage compresses time. It forces decisions under pressure. It removes optionality. If you can survive volatility without being forced out, you retain control. If you cannot, the market controls you. The second lesson is about physical confirmation. The Shanghai Premium acted as a structural indicator for months. When Chinese buyers were paying $72 above Western pricing, it signaled real demand. When that premium flipped to a $14 discount, it signaled a withdrawal of physical urgency. Paper markets can detach from fundamentals temporarily, but sustained dislocations require physical validation. When physical validation disappears, leveraged paper positioning becomes unstable. Monitoring cross-market pricing relationships offers early warning signals that charts alone cannot provide. The third lesson is narrative flexibility. Narratives simplify complexity. They help investors frame macro trends. But when narratives harden into certainty, risk management deteriorates. Gold to 6,000 felt inevitable. Silver to 200 felt reasonable within that narrative framework. The dollar collapse felt structurally guaranteed. But markets are dynamic systems. Conditions evolve. The strongest participants hold narratives lightly. They are willing to adjust when evidence changes. Now let's focus on forward structure. Gold holding above 4,900 is technically significant. If that level consolidates and forms support, the longer-term bullish structure may remain viable. The purge of excess leverage may have strengthened the foundation. If gold breaks decisively below that level with sustained selling pressure, then deeper retracement becomes more probable. Deleveraging cycles often unfold in stages rather than singular events. Silver's $75 to $76 region is equally important. However, silver's volatility profile means overshoots are common. Investors in silver must accept broader fluctuations. Mining equities remain a separate but related consideration. Large producers like Newmont and Barrick possess diversified asset bases and operational resilience. They remain profitable at current gold prices. If consolidation accelerates, financially stronger firms may acquire distressed assets at favorable valuations. Mid-tier miners that were previously priced for perfection now trade at discounted multiples. That environment can generate selective opportunity. Junior explorers dependent on capital markets face higher risk if liquidity tightens further. Balance sheet strength, cost discipline, and management experience will matter more than promotional narratives in this phase. Now revisit liquidity one more time. The DXY moving toward 100 signaled tightening dollar conditions. In liquidity contraction, cash demand rises. Even strong assets can decline as participants raise dollars. This does not invalidate long-term de-dollarization themes. Structural diversification trends unfold over years, not weeks, but short-term liquidity pressures can override long-term positioning. Understanding time-frame alignment prevents misinterpretation. Short-term volatility does not automatically negate long-term thesis. Long-term thesis does not protect against short-term drawdowns. That distinction is essential. So what should disciplined participants focus on now? First, remove urgency from decision-making. Volatility compresses emotion. Emotional decisions amplify error. Second, reassess exposure honestly. If recent volatility felt unbearable, position size likely exceeded comfort thresholds. Third, monitor structural indicators rather than social sentiment. Shanghai pricing relationships, gold-silver ratio stability, Federal Reserve expectation shifts, dollar strength trends. Fourth, accept that consolidation phases often follow liquidation events. Markets require time to reestablish equilibrium after violent repricing. Equilibrium forms through time, volume distribution, and gradual rebuilding of confidence. Now address the core question again. Is the bull market over? Possibly. Was this simply a violent reset of excess leverage? Also possible. Certainty does not exist in markets. Probability does. If physical demand stabilizes, if 4,900 holds, if liquidity conditions ease, the structural bull case may continue. If liquidity tightens further and technical support fails, additional downside could emerge. Adaptability matters more than prediction. As of Friday, February 20th, volatility remains elevated but structure is forming. The easy momentum phase is over. The emotional extremes have been exposed. What remains is a market recalibrating. The speculative froth that carried gold to 5,627 and silver toward 120 has largely been cleared. Weak hands have exited. Forced leverage has been reduced. What is left is opportunity for disciplined capital. But discipline is not optional. Survival during crashes determines participation in future rallies. Everything discussed here is based on publicly available data and observable market behavior. This is educational analysis, not financial advice. Decisions must align with your own research, risk tolerance, and financial circumstances. Professional guidance should be sought when necessary. Markets are not designed to move in straight lines. They are designed to test conviction, punish excess, and reward preparation. Stay patient, stay measured, and understand that volatility is not failure. It is part of the cycle.